We are living through one of those rare turning points in financial history, the kind of shift that happens once in a generation and sets the stage for everyday people who struggle to keep up, a very unique opportunity. Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. Right now, regular workers, small business owners, side hustlers are standing in front of a once-in-a-lifetime chance to turn a small amount of money into massive wealth. And the reason for that? Interest rate cuts. The central banks of the world are preparing to slash rates. And while it might sound like something only Wall Street insiders care about, this is the spark that could launch an entirely new wave of fortunes. The media is spinning the story as an economic crisis, job growth is slowing, unemployment is ticking up, and the bond market is flashing warning signs of a recession. But history tells us that moments like these, when fear dominates the headlines, are exactly where opportunities are born. The key is understanding what falling rates means for assets like stocks, real estate, gold, Bitcoin, and even the value of your dollar. Once you see it clearly, you'll understand why the next chapter may create more everyday millionaires than in recent memory. So buckle up. By the end of this video, you'll not only understand what's happening in the global economy, but you'll also know how to position yourself to turn these shifts into generational wealth. So without further ado, let's get right into the video. The first thing we need to get straight is what's actually happening in the economy right now. CNBC reported on Tuesday, September 12th, that the labor market created far fewer jobs than previously thought, according to a Labor Department report. This further fueled concerns about the overall health of the economy and the accuracy of the previous collection of data. Not only were August payrolls weaker than July's, but revisions also showed June slipping into the red with a loss of 13,000 jobs, making it the first negative tally since December 2020. With only 22,000 jobs added nationwide, according to the revised August jobs report, that has pushed unemployment to 4.3%. On the surface, that might not seem catastrophic, but the trend is what matters. Job creation is slowing, layoffs are rising, and consumer confidence is sliding. Add in high credit card debt and record household expenses, and you've got an economy that feels like it's running out of steam. The Federal Reserve knows this, which is why they're preparing to cut rates aggressively, possibly by 0.5 percentage point in a single move, which we'll see on Tuesday, September 16th through Wednesday, the 17th. That might not sound like a big deal, but it's a massive shift. For months, the Fed was telling us rates would stay high to control inflation. Now, the sudden pivot to cut rates tells you just how worried they are. And it's not just America. Across Europe, the UK, and Japan, bond yields are soaring even as the central banks whisper about cuts. That disconnect is the financial system way of screaming, "We don't trust you anymore." In fact, we might already be in a recession already. It's getting hard to believe that inflation or debt can be controlled no matter what the Federal Reserve does at this point. In a previous video, I talked about the bond market and how if you understood that, then you would understand how money works and you would always be able to generate money. Now I know what you're thinking. I don't buy bonds. I don't care about bonds. Why should this matter to me? But here's the truth. Bonds control everything. They set the cost of mortgages, car loans, credit cards, and even determine whether companies can borrow cheaply to expand or have to cut back and lay people off. Think of bonds as the plumbing of the financial system. You don't see them, you don't think about them, but if the pipes burst, everything else will collapse. And right now, those pipes are under enormous pressure. US 10-year Treasury yields went from under 1% in 2020 to over 4% today. That is the fastest increase in 40 years. In Japan, yields are breaking records after decades of being pinned at zero. Based on financial reports from early September 2025, Japan's 30-year government bond yield has risen sharply and is approaching the recent performance rate of gold, a historically zero-yield asset. This situation is driven by a global bond sell-off amid fear of rising government debt and policy uncertainty. In the UK, long-term bond yields are back to levels not seen since the late 1990s. Long-dated German and French bond yields surged in early September 2025 to multi-year highs due to rising fiscal concerns, political instability, and increased defense spending plans in Europe, leading investors to demand higher premiums for holding these sovereign debts. The French 30-year bond yield hit its highest level since 2009, while German 30-year yields have reached their highest point since 2011. Normally, when central banks cut rates, bond yields fall. That's how monetary policy is supposed to work. But right now, yields are rising even as rate cuts loom. That means investors don't believe the Fed or the Bank of England or the European Central Bank can control debt and inflation anymore. This isn't just another cycle, it is a structural break, and history shows that whenever bonds stop listening to central banks, the world is on the edge of a reset. In that bond video, I introduced you to some of the basics of the bond market and why the yield curve is so important. But today, I want to build on that by showing you how the current situation is unlike anything we've seen in decades and why it could be flashing a big red warning sign for the global economy. Let's start with a quick refresher. At their core, bonds are nothing more than loans. When you buy a government bond, you are effectively lending money to the government, and in exchange, they promise to pay you back with interest. That interest rate or that return is what we call the bond yield. Now, here's the golden rule you need to remember about bonds. Prices and yields move in opposite directions. Think of it like a seesaw. When bond prices fall because investors are selling them, yields are going up. When investors buy bonds, prices rise and the yield drops. This up and down sets the tone for almost every interest rate that you'll encounter in your financial life. The problem right now is that yields are rising at breakneck speeds. In the United States, the yield on the 10-year Treasury has gone from under 1% in 2020 to over 4% today. This is the steepest and fastest climb we've seen in 40 years, but this isn't just an American story, it's also happening all over the world as previously stated. For more context, Japan's bond market was essentially frozen. The Bank of Japan held yields near zero through a policy called yield curve control. Investors used to joke that Japanese bonds were as boring as it gets, but just this year, the cap came off. Yields immediately surged to record highs, shocking global investors who had come to see Japan as one of the most stable bond markets on the planet. Over in the UK, the situation isn't much calmer. 30-year bond yields are now at levels last seen in 1998, even though their economy has been crawling along at one of the slowest growth rates in the world. When long-term borrowing costs rise this high in an economy that isn't growing quickly, it raises big questions about sustainability. This isn't a normal cycle. Something bigger is happening right now. Central banks may say that they're in control, but the reality is that the bond markets are pushing rates higher no matter what policymakers announce. When bonds stop listening to central banks, history tells us it's usually the first sign that something deeper is broken in the financial system. Now let's bring this back home to the US. The 30-year Treasury bond is knocking on the door of 5% yields if it hasn't already touched that by the time you're watching this video. And what's bizarre is that this is happening while the Federal Reserve is hinting at rate cuts. Think about how strange that is. The Fed is basically saying, we're going to lower rates, but the long-term bond market is saying, nope, we're not buying that. We want higher returns to lend you money. That disconnect is a flashing signal, and this brings us to one of the most reliable predictors of recessions, the yield curve. For those who need a quick reminder, the yield curve is simply a line that shows interest rates across different maturities. Normally, it slopes upward. That makes sense. If you're going to lend money for 10 or 30 years, you expect a higher return than if you locked it in for just 2. The longer the loan, the bigger the risk, so you demand more compensation. But for the past couple of years, the yield curve was upside down or inverted. This means short-term rates were actually higher than long-term rates. In practical terms, it became more expensive to borrow money for 2 years than for 10 years. That's not supposed to happen in a healthy economy. It's almost always a warning that a recession is on the horizon. In fact, if you look at every major recession in modern US history, almost all of them were preceded by an inversion of the yield curve. It's like a countdown clock. You don't know exactly when the bell will ring, but you know the timer has already started. And here's where things get even more concerning. In 2022, the US yield curve inverted and stayed inverted for nearly 2 years. That is the longest inversion on record, and while we haven't officially declared a recession yet, the data would suggest that something is brewing under the surface. Now here's where a lot of people get confused. Recently, the curve has started steepening again. At first glance, that sounds like good news, right? A steep curve usually means the economy is healthy and growing. But in this case, the steepness isn't happening for the right reasons. In a healthy recovery, the curve steepens because the Fed cuts short-term rates while long-term rates stay relatively stable or drift only slightly higher. That's the good steepener. It signals borrowing costs are easing in the near term, and investors trust that inflation is under control over the long haul. But what we're seeing today is a bad steepener. Short-term rates are still painfully high, making it expensive for households and for businesses to borrow, and at the same time, long-term rates are rising even faster. This kind of steepening means investors are basically saying we don't trust the government to manage debt or inflation in the future. And if you want us to lend for 10 or 30 years, you're going to have to pay us a lot more. That's what economists call a bear steepener, and it's not good news. It would suggest rising distrust in the system itself and often precedes economic pain. All of this might sound bleak, but this is where things get exciting. Every major recession in history has often been a launchpad for massive wealth creation. Take the early 2000s. The dot-com bubble wiped out trillions of dollars in paper wealth. Tech stocks collapsed, and people said the internet was overhyped. But those who bought into Amazon, Apple, and to Google during the crash became millionaires as the digital economy took off. Look at 2008. The financial crisis was brutal. Housing collapsed, banks failed, and unemployment soared. But people who bought real estate at the bottom or loaded up on index funds saw their wealth multiply in the 2010s. A house that sold for $120,000 in 2010 might be worth $600,000 today. The S&P 500 more than tripled over the next decade. Then there's 2020, when the pandemic hit. Markets fell 30% in a matter of weeks, but the Federal Reserve responded with massive rate cuts and stimulus. And what happened next? Stocks soared, Bitcoin skyrocketed, and real estate went on a record-breaking run, which it's still on today. Investors who stayed in the game made a fortune in just a couple of years. The pattern is clear. Panic creates bargains, rate cuts ignite recovery, and those who invest through the chaos are the ones who will come out ahead. So, how does this economic downturn translate into wealth? Well, let's break that down, starting with stocks. During recessions, fear takes over. Investors panic, they sell off shares, and prices tumble. That means high-quality companies, the Apples, the Amazons, or Nvidias, or even simply the S&P 500 index fund can trade at huge discounts compared to their real long-term value. If you're buying when everyone else is scared, you're essentially shopping the stock market at clearance prices. In the situation we find ourselves in currently, to fight recessions, central banks like the Fed will cut interest rates. Lower rates make it cheaper for businesses to also borrow and invest, which boosts future profits. They also make stocks more attractive compared to bonds, and that's why recoveries after recessions often see powerful rallies. And those who bought during the downturn capture the biggest gains. Now we'll look at real estate. Mortgage rates are tied to long-term treasury yields. When yields fall, mortgages become more affordable. At first, interest rates can feel high heading into a recession, as they probably do right now. But once the downturn deepens, central banks usually slash rates to jumpstart the economy. That's when refinancing opportunities open up. Smart investors will buy when prices are lower, even if rates are higher initially, then they can refinance into cheaper debt later. That combination of buying low and financing cheap later on is a recipe for long-term wealth. Gold, on the other hand, thrives when investors lose trust in paper money. Normally, higher yields push gold lower because bonds offer safe returns. But the fact that gold has been rising even as yields climb shows deep distrust in the system. If rate cuts come, gold could surge even higher. Which brings us to Bitcoin. Bitcoin acts like digital gold. In the short term, it's volatile, but in a world where governments keep printing money and running deficits, Bitcoin shines as an asset outside the system. Rate cuts could bring in new liquidity, and that will go into crypto markets, fueling another bull run. However, here's the danger. Every wealth boom in history has a catch. Rate cuts can inflate bubbles that can create speculative manias, and when those bubbles burst, latecomers get crushed. That's why this moment isn't about just jumping blindly into whatever hot. It's about building a strategy. You don't want to be the person who buys at the top because of FOMO. You want to be the person who accumulates smartly when fear is high and everyone else is running for the exit. This is where everything comes together. Generational wealth isn't built by guessing what the Fed will do today. It's built by owning the right assets through the cycles. That doesn't mean you need millions of dollars to get started. Even a few $100s invested consistently during downturns can compound into life-changing wealth over decades. The secret isn't timing the exact bottom. It's having the courage to keep investing when the news screams recession. Now, let me share with you how I'm approaching this moment. I'm not trying to guess which month the Fed will cut rates or whether the next job report will be good or bad. Instead, I'm building a portfolio that benefits from rate cuts and economic downturns over the long term. I hold stocks across sectors, but I'm overweight in tech because I know they benefit most from falling rates. I'm looking at real estate, though I'm patient about timing my purchases. I hold gold as insurance against chaos. And Bitcoin has become a bigger and bigger part of my portfolio because it's one of the only assets not tied to government debt. I also keep cash in short-term treasuries, so if the market does fall further, I do have cash to buy. That way, I'm not forced to sell assets at a loss just to raise money. I want to thank you guys so much for watching this video. Most recessions end through a combination of rate cuts, government spending, debt resets, and slowly returning confidence. Markets almost always recover first, which is why fortunes are made by those who invest while they still look bad. And the question is simple: will you be one of the everyday people who turn this moment into generational wealth? If you found this valuable, make sure you subscribe and don't miss my next breakdown. Drop a comment with your thoughts and let me know how you're preparing for this moment. And remember, the best investment you can make is not just in stocks or Bitcoin or real estate, but it's in your own education. Because the more you understand how money moves, the more wealth that you can build, not just for yourself, but for your family and your future generations. Once again, thank you so much for watching this video, and you have a wonderful day.